man, it's time to do another Q&A video.
Hey everyone, Ryan Bolton here, local mortgage expert, ryanbolton.com, here to answer your questions about real estate and the mortgage process. Found some great questions online, had a few comments online. I really appreciate those people that are engaging with the channel and asking questions, liking, sending stuff to my Facebook page as well. So really appreciate the interaction. That's what's fun about the job, is being able to help people with their home loan needs. I do lending in Utah and Nevada, so some of these questions may not be specific to every area in the country, but I've been doing home loans since 1999 and would love to help you with any questions you have on buying or selling or refinancing a home. So let's jump into some questions that I found here. The first one is, why are mortgage rates on refinances higher than on a purchase? So that's a great question. It's higher risk. Whenever you're refinancing a loan or pulling out extra cash, there's a hit to the interest rate versus when you're first buying it. It's just the hits that are based on the risk of foreclosure. When people go through a refinance, even if they're saving money or paying off debts or pulling out cash or doing things with those funds, it still is a higher risk of defaulting than the original purchase, just statistically. So because of that risk, interest rates are higher on those particular programs. So your best rate is going to be on a primary residence purchase, then a primary residence rate and term refinance where you're not getting anything back up to $2,000 other than covering closing costs. So pulling out the money to pay for points and fees and title appraisal, that doesn't count towards that. Anything you net in your pocket or use to pay off other debts more than $2,000 is considered a rate and term refi. Now, what if you're paying off a second mortgage? I think this is going to happen here in the next few years as people have done a lot more lines of credit. They might look at rolling the first and second into one loan. If the loan that was used to purchase the home was a first and second, then it's still a rate and term refi. But if you bought the home and then added a line of credit years later and then try to refinance both together, that's going to be considered a cash out refi, which is then another tier on the interest rate. Then you get into property type, then you get into property use. So if it's a condo or townhome, there's a hit. If it's a manufactured home, there's a different program. If it's an investment property and has been on the tax returns as receiving rental income. Now, this can be a little tricky because of the verbiage of the industry, but second home or vacation rental is still considered a rental property, not a second home. So if on the tax return you've claimed income on that property, it becomes a rental property, even if you use it as a second home and just rent it a few months out of the year or something like that. So as you go up that ladder, the rates get higher to offset risk. So really, when you think about it, if you have a primary residence and you run into financial difficulties with your job or whatever it might be, and you have a rental property and that renter just trashes the place or doesn't pay their rent and you start missing mortgage payments, you're more likely to miss the rental property than your primary residence where your family and your kids are, that type of thing. So they go into foreclosure more often. And because of that, that's why you'll see higher rates on that type of loan. So hopefully that answers that question. Let's go to a couple other ones here real quick that I found. Hope everyone's having a wonderful day. Is the HOA fee included in the mortgage or is it separate? An HOA fee is homeowners association. These are where you have condos, townhomes, PUDs is what they're often called, where there's a common area, maybe pools or tennis courts or clubhouses or things of this nature that are in that community that everybody shares in the expense of maintaining those things. A lot of HOAs here in Southern Utah will include some sort of landscaping where they'll cover maybe the front yard, maybe even the rear yard. They'll cover pool areas, tennis courts, basketball courts, all those things. So usually there's yearly fees associated with maintaining those common areas. So all the homeowners kind of chip in to cover the cost of that. Now, love them or hate them, HOAs are more and more common because they do spread out the cost of those things and usually keep the communities in a little better shape. They have a lot more rules, which some people like and some people don't. But the idea is to be kind of a common area covering these expenditures. Or let's say the pump on the pool breaks down, or it needs to be relined, or needs to be fixed, or something like that. There's a fund that's created that everybody kind of chips in to cover those things. I often say the people that hate HOAs, why don't you donate some time and be on the board or be a member of the people that are making the final decisions on stuff? And you'll start seeing a lot where the money's going and the hassles you have to deal with to even be a president or a treasurer or a secretary on an HOA board. They are getting outsourced a lot more, where you have management companies that are collecting a fee to manage all the day-to-day operations of the HOA, to collect payments, deal with landscapers, things like that. But the short answer to this question, is HOA fees included in the mortgage or it's separate? It is separate. It is not something that gets escrowed like your taxes and insurance. So it is a monthly bill you get on top of your principal and interest on the loan. Your taxes and insurance on the loan do typically get rolled in, or can. The HOA is a fee on top of that. Let's see, next one. What is a mortgage modification? A mortgage modification is where you're not able to qualify for a refinance because of either income, assets, job, a death, just something that's changed about your original loan application where you couldn't re-qualify for that loan on a traditional refinance. Modifications got really popular during 08, 09, 2010 to prevent people from going into foreclosure by just modifying their loan terms without them being able to actually qualify for a refinance. Now, there's still qualifications for a modification. If your income has dropped to zero, they're unlikely to help you with a modification. So it is something where it doesn't prevent a full foreclosure on the property, but it's kind of a step down. Now, it does affect your credit because usually you'll have a lot of lates on your mortgage account, or if you modify the loan, it usually has to be in some sort of state of deferment or default or late or something like that. But essentially, it's just a short-term agreement between you and the lender that says, okay, instead of foreclosing, let's modify or adjust the payment I can now afford to allow me to stay in the home. Then once that modification's over, it reverts back to original loans, or maybe you can refinance or sell at that point, but it just buys you some time so you don't lose the home in foreclosure. So I don't think we're going to see as many modifications because people can sell or refinance. So I don't know if lenders are going to be as open to modifications as they once were, but there is guidelines and terms that determine if you'll get a modification. Let's see. How long does it take to get an approval for a home loan after being denied by one bank? So just because one bank denies you doesn't mean every lender is going to deny you. Some lenders are very conservative. Maybe they only want a minimum credit score. Maybe they only have a certain book of business. Maybe they don't do FHA loans or USDA loans or all these types of loans. That's one of the benefits of working with someone like me is we have every mortgage that's possibly out there in Utah and Nevada, we have access to. So we don't have to tell clients they're denied very often. Now, if you've got a 400 credit score looking for 100% financing, that's going to be pretty tough with any lender if it even exists at all. So part of my job is to say, okay, here's where you're at right now. Here's the programs you qualify for. Let's work on strengthening your file to get you into these other tiers that open up different loan programs. But as far as going and checking with another lender after you've been denied, it depends on why. So when you do check with another lender, tell them kind of what the issue was, but it could be the same day. You know, when you're denied by a credit union or bank down the road, doesn't mean every lender is going to deny you. And I don't have any way of knowing if that lender denied you for a loan. Now I can see the credit inquiry and say, okay, it looks like you applied at, say, Chase or Wells Fargo or something like that. But it doesn't mean I know that they denied the loan for any particular reason. So just because you got denied with one lender doesn't mean every lender is going to deny you. What else we got? Can you refinance an existing mortgage using a VA loan if the property has significant improvements since purchase? Yes. Yes, you can do a VA refinance, so it doesn't have to be just a purchase loan. I'm amazed at how often people think they can only use their VA, and VA is veterans or a veterans association. So these are people that have served in the armed forces. They have a specialized loan program that helps them buy a home. It's not just a first-time homebuyer loan. It's not just a one and done, like you use it for your first home and you never use your eligibility again. The only downside is you can't have more than one VA loan out at any particular time. So you'd either have to sell or refinance a property to get VA off of that loan. Say you had a first home and you decide to turn it into a rental property and you try to go use your VA eligibility again, you'd first have to refinance or sell that property to release your eligibility for the next home. There is an exception that if you have a husband and wife that get divorced and she gets the home and you get to go buy another one, that's one of the few exceptions to be able to have two at a time. But that's the only one I know of. I think I've heard of maybe one or two other ways, but really you only can have one VA loan out at any particular time, but you can use it as many times as you want. It's one of the best loans on the planet. So if you have VA eligibility, I'd love to talk to you. I can help you get into a home loan. It's a wonderful loan. It's one of the best loans out there. So, yes, you can do a refinance on a VA loan after you've done improvements to either better the rate. But most likely, that's not going to be a lot of rate reduction, but that is something where yes, you can do that. All right, how are we doing on time? Ooh, man, we're doing great. I try to keep these, 20 minutes or so. So if you have a comment, question, concern, please put it in the comments below. Love to add that to a future video. Let's see. Does the mortgage have to be paid if the house is rented out? Does the mortgage have to be paid if the house is rented out? What would you think would happen if you don't make your mortgage payment? You lose the house. So just because you have it rented or somebody else is using it, or you're co-signed on the loan and they stop making their payment, they come after the house. They start reporting the credit negatively. So yes, the mortgage still has to be paid. That's the collateral for the loan. So no pay, no stay. They'll take the home back. Now it gets a little convoluted when there's a renter and a lease agreement, things like that, but it is still something. That's the collateral for the loan. So if you don't make the payment, they get the house. All right, let's see what else we got. How will you know if your mortgage application was rejected? Within certain timeframes, they're supposed to tell you the status of your loan application, whether it was withdrawn, denied, or that type of thing. So they're supposed to tell you every time they pull a credit report within a certain time frame what happened with that application. So it shouldn't take long. But if you don't know, like within hours or days at the very most, the lender's not calling you back or something like that, don't work with that mortgage company. They should be able to tell you right away or pretty quickly if your loan's going to be approved or the steps it would need to get your loan approved. So if you haven't heard if your loan application is rejected, use a different mortgage company or keep calling until you find out. That's the best answer I have. But by law, they're supposed to tell you what they did with that application. Let's see. Having multiple co-signers on a loan, is it bad? No. Depends on the situation. I've had as many as 6. I went back and I had a client that just had like a husband and a wife, a kid, a brother, just to get qualified. They had to put a bunch of people on this loan. And some of it was also for estate planning and stuff. They just wanted to be on the loan and on the application and on the title report, things like that. So, but when you're a co-signer, you are equally responsible for that debt. So let's say it's you and your son or daughter. This is probably the most common co-signing in some sort of family relationship, I would say. So if your son stops making the payment, it affects his credit and yours. It will show up as 30 days late, as 60-day late, possible notice of defaults, foreclosure if it gets that far down the road. So it is something where you want to monitor either your credit or, more importantly, get an alert from the mortgage company if a payment's not due. Many, many mortgage companies have gone paperless. They'll send you a text. They'll start calling you like crazy that if a mortgage payment hasn't come in within the grace period or even just after the grace period. Now, also consider this. If you make your payment on the 20th day, that will not show late on the credit bureaus. It has to be past 30 days or 31 days, basically one calendar month, that it has to be late before it starts reporting to credit. But the last thing you want to do is find out that your son or daughter hasn't made the mortgage payment either on purpose or is nervous or doesn't want to tell you or forgot or whatever the reasons are out there. Before you want to find that out well before it gets 30 days late, because that affects your credit as well. So anytime you co-sign on a mortgage, you're equally responsible to make that payment, and it will equally affect your credit report. Let's see, we're about 13 minutes. Let's do a couple more. Can we take out a second mortgage on the primary residence for investment purposes? Yes. Short answer is yes. You can use a line of credit or a second mortgage to buy another property, to work on your property, pay off debts. So yeah, the short answer is you can use those funds to purchase a home. Now, a lot of times what we're going to see on the lending side of it, we're going to want to know what that money that's being pulled out, how that changes the payment on the second mortgage or the line of credit. So we just have to add that to the debt ratio. But short answer, absolutely. You can use the money from your home, whether it's a second mortgage or cash out refi or something like that, to buy investments, whether it's investment properties, crypto, stock, whatever you want to do there. Let's see. How long does it take to get an approval from a bank? It shouldn't take long. So how long does it take to get a pre-approval from a mortgage company? It shouldn't take very long. It really shouldn't. The application I mean, I can get them done in minutes, literally minutes with technology and pulling the credit. I can do it remotely. I can do it right from my phone. So there's a lot of things I can do to issue a pre-approval letter literally within minutes. Now, if you're taking days to get one, you're using the wrong mortgage company. There shouldn't be a mortgage company on the planet that takes you days to let you know if you're pre-approved. Now, full approval can take more time because you need title work and appraisal and income and asset documentation, verifications, all that. But as far as pre-approval, if it's taking more than an hour, I mean, it really should not take that long to get a pre-approval. Now, if it's Sunday at 12 o'clock, okay, maybe might be a little different story, but no, it should not take hours or days to get a pre-approval. If it is, you're using the wrong lender, flat out. I'm going to say it, calling all you lenders out to task. If it takes you days to do a pre-approval letter, don't. Use me instead. All right, let's see. Let's go with a couple more here. Oh, let's see. Oh, if a property is jointly owned, can a co-owner apply for a home loan? You can apply, sure, but you won't get it closed because anybody that's on that property has to sign documents that are notarized that puts that lien against the property. So no. So this happens in divorce situations, unfortunately. Maybe this happens with a son or daughter that's trying to get a line of credit and they don't want their parents to know on the loan. But once it's a joint account, so in Utah, you're not 50-50 owners where you could do a loan against 50% of the asset. You're both 100% owners. You can't do anything buy, sell, refinance without all parties being involved, or the trust or whoever's on the title report has to sign off on anything that affects ownership or lien position or anything like that. So you can apply. Sure, this says apply, but I'm assuming you wouldn't want just to apply if you're not going to get the loan. So no, you cannot get a loan on a property without all owners signing off on that new lien or change of ownership or whatever that it happens to be. All right, let's go. Excuse me. Is it beneficial to pay more than your monthly payment on a home loan? Sure, it pays off the debt faster. But here's what I would say to that. I think it's honestly better when you're to round up your payment, sure, maybe make it an even number so you're putting a little bit extra towards principal. But honestly, I think you're far better off taking that money and increasing savings, increasing emergency funds, increasing paying off any other debt. $100 is going to go a lot further on a car loan or visas or other types of loans than towards a mortgage. And I really think more people need to have more savings and emergency funds, having retirement accounts. Too many people live paycheck to paycheck. So putting extra towards a home, great. That's great. If you don't keep it for 30 years, if you don't ever pay the thing off, you have more equity when you go to sell it, but you can also have more money in the bank in case of emergencies or use that to lump sum and really pay down the mortgage. Now, some of it depends on interest rate, of course. There's other factors involved, but almost every time I've run the numbers, I don't care if the rates are 10%, having 100,000 in the bank versus 100,000 in equity, what would you prefer? What cash flows better? What can you get to easier than selling or refinancing your home, especially if you have any other debt? Now you say, okay, well, I got 7% on my mortgage, but my car loan's only 2%. But your car loan's $400, $500, $600, $700 a month. You could take that same amount, put it in savings, or put that towards the mortgage, which will really accelerate the balance. So I really feel mortgage ought to be lowest on the totem pole, regardless of rate in most cases, and everything else gets paid off. But savings first. Have 6 months worth of your expenses, or at least the mortgage payment, in the bank. You never know what's around the corner. You don't know car accidents around the corner, or job loss. All those things, you can't get to your equity if you lose your job without selling the home. So why would you put all your money into equity that you can't even get to? Have some of it savings, emergency, have that established, have other debts paid off, then start paying extra to the mortgage. All right, looks like we have one more minute before we hit about the 20-minute mark here. So hopefully we don't get into a huge soapbox here. Let's see. This is an easy one, I guess. What is the difference between private mortgage insurance and public mortgage insurance? Just who's insuring it. So public, I would assume, it says PMI and PMI in abbreviation, so it's really not that. But you've got government-backed mortgage insurance, then you have private mortgage insurance. It's really the guidelines that determine when you get the insurance. So typically higher credit scores, more money down, those are typically better for private mortgage insurance. First-time home buyers, less money down. Usually the government-backed mortgage insurance is just cheaper. So that's part of my job. Here's mortgage insurance from here, from here. There's even mortgage insurance you can pay a one-time fee and just remove the monthly expense. You don't need 20% down to get rid of mortgage insurance. You can pay a 2% fee and it's gone. So instead of putting 20% down, you can put 5% down, pay the 2% fee, and it's gone. I've seen it as low as 1%, depending on credit scores, debt ratio, factors like that. So private mortgage insurance is a little more flexible on how you pay it, how much you pay it, but it requires a little higher score, a little more money down, where government loans or government-backed mortgage insurance, it doesn't matter if you're a 620 score all the way up to 900. You either get the loan or don't, and that's the insurance that they tie to it. So there's benefits and disadvantages with both. The big thing with FHA insurance as well, since about 2013, you can't get rid of it without selling or refinancing, where most private mortgage insurance you can, but it can be as much as 10 years before you can get rid of it. So there's a lot of differences when it comes to mortgage insurance. So I hope you found this information useful. I really enjoy it. I like answering questions. I don't pre-screen these. I just go with them. So sometimes I actually watch the video and I'll see a question and I kind of reread it and go, oh, maybe I went down the wrong rabbit hole on that question. But I really hope this information is useful. I really have a lot of fun doing it. I'd love to help you with a home loan to purchase or refinance in Utah or Nevada. So check out my website at ryanbolton.com and look forward to doing another video with you and hope you have a wonderful day.